Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, March 19th, 2020. Second video of the day. The first one I covered just stuck with the equity markets, showed you some levels to watch, what I'm expecting, some upside today, which, we've already had a decent amount of. I do think there's more, but again, I cannot caution enough that we're in a downtrend. This could be a dead cat bounce. We're also within a trading range, so until and unless that's resolved, that's the MO. Let me just go back to that. I was catching up on comments in the comments section from yesterday's closing marker app video. A couple people asked, what did you think about the big move down in the futures last night? And my reply on one of those was this: it was perfectly normal, in fact, to be expected. We had the bear trap there. And in the post that I put out 38 minutes before the close yesterday, it had the arrow scenarios going up to exactly where we reversed to that trend line and that 75.57 level. And so that was it. And what that is the reason the arrow stopped there, that is significant resistance. And if you just take a step back, and again, I'm maybe beating a dead horse here, we've been in a trading range recently, locked in, and the MO, modus operandi, anytime you recognize a trading range in a stock or in the market, the MO is to go long at the bottom of the range and or cover your shorts if you shorted down, and then go sell those longs in reverse or go short at the top of the range until there's a breakout. And you can, by going long at the bottom of the range, you put a stop there. Like I said, I suspected, and I had said that now 3 days ago, that they could run at that level because it was such an obvious level. And look, the same thing can happen to the top of the range. In fact, I wouldn't be surprised at all. We pop it, and then they turn around and sell it real hard. It proves to be a false breakout. So there's a lot of trickery in this market, and I know I'm throwing out a lot of, hey, what could happen? And the thing is, you have to react to that. So far the fundamental case has not improved. If anything, it's gotten worse. I was in Home Depot last night, and they told me, I talked to one of the guys there, said as of today, they're going to start closing the store at 6 p.m. It just shows you that's, just a point is the trend. I haven't seen one, anything going positive as far as the, economy and the fundamentals like that go. I hear of restaurants after restaurant closing down. And again, Home Depot cutting back on their hours. Costco here in our area, at least, only letting 30 people in the store at a time. Sold out. They have signs out in front. They don't have any paper goods. And if you're wondering too, I'm just going to digress, throw my thoughts out here. I was talking to somebody about this the other day that said, oh yeah, the grocery stores must be making a killing lately. And my answer is no. Here's the thing. In Florida, at least, and most other states, I know Florida, we have anti-price gouging laws because, Florida, we're prone to hurricanes, and back in the day, a lot of companies, stores would take advantage of that and, raise prices considerably. So they can't do that. And then, of course, a bigger company, a grocery store chain, an established chain, they're not going to do the price gouging, or Costco, for example, just because it's very bad PR. It's not worth it to them. So where I'm going with this is, yeah. So did they get a surge in sales? Yes, but that's front end load on demand or sales, but a back end drop off because those, let's just say it. I've heard a lot of stories out there. There's some real jerks that are going into the store and filling up a shopping cart with toilet paper, whereas, instead of just taking what they might need for the next couple months. Now, what that's doing, it certainly boosts. It's a short-term boost in sales, but you're not going to use any more toilet paper than you would be using over the next year. Your body functions remain the same. Same thing, grabbing paper plates and cups and everything else and all this food. So again, the grocery store has been wiped out in inventory. Sure, the registers are a little flush lately, but then that's just going to lead to a slower, demand for those products in the coming months as people have now stockpiled it. So I just want to throw that out. If you're looking, you got to really dig in and see which companies are truly going to profit from this longer term. All right, let's talk again. Let's get back to the markets here. So that that move last night, that drop in the futures again was simply a reaction, just like every other time before that we hit this level once we've established just as a trading range, and we fell right back down to where buyers have been stepping in and did once again step in. So my answer to that question about what do I think of that move last night, it's just noise. This is what I call noise within a trading range. This is these big 10% back and forth swings, 8 to 10 or whatever it is, it's just the current MO of the market right now. That's it. Now, no trading range lasts forever, so chances are we could have another whipsaw. And again, I see the upside as being very, very limited. But what could spark a rally, if you're wondering what possibly could, with everything still getting worse, would be some headlines with some type of abatement of the situation. In other words, they come out and say, wow, it seems the virus is not as contagious, or number of new cases have fallen off sharply, or the mortality rate was overestimated, or something like that. It doesn't take much to cause an explosive short covering rally when the market's this oversold. So I'm just going to reiterate what I've been saying for the last few days. I have, as far as swing trades go, active trading is I'm in and out so quick it's not even worth. I'll post the levels to watch. I'll give them to you in advance, and you guys can trade off those if you want. But as far as swing trades, don't expect another short trade on QQQ right away. And I do, but you will want to look for one or short trades on the market, maybe some individual stocks at some point. So let me kind of just loop back over to my thoughts here in the bigger picture. At some point, whether it comes anytime soon or whether it's months away or weeks away, we are going to have a real bear market rally. So far, we've had little kickback rallies, and again, they're very powerful in percentage terms. But I'm talking a trend, a tradable trend that lasts more than just a few days. And what it's going to do, that rally, when it comes, when it comes, not if it comes, whether it comes from anywhere around here, whether it comes from much lower levels, that's yet to be seen. But what it's going to do, it's going to convince the masses, because it's going to be so powerful. The more we go down, the more we become oversold. If we do continue to drop for a while here without a rally, the more powerful the snapback rally has been. And then, the one certainty in the markets is nothing goes down forever, and things that tend to go down too far too fast or up too far too fast, you have a much sharper recovery. So you can go back in time, and I've done this, measure out the bear market rallies. This is probably one of the closest examples, because the bull market that we're in now only comes close to the one leading up to the dot-com bubble in 2008. And really, you want to look at it on the S&P 500. The Nasdaq was very tech heavy, but you still had, again, the duration and scope of that bull market from the early 90s all the way up to the dot-com bubble bursting in March of 2000 is the closest analogy that we have, or comparison, to this current market. This one now, this bear market's starting off with a bang. But again, if you really zoom in tight there, and you can measure these counter trend rallies, the bear market rallies, I love to trade them. I'll be looking forward very much to the next one, whether we're about to see it right now. I'm open to that possibility. I've given you guys some upside targets that are pretty substantial. When you go back to SPY, for example, off the lows so far, or let's just go from where we're at now. If that third target is hit, just assuming it's hit, you're talking about a 13, almost 14% gain. Yeah, right about 14 from where we're at right now. And 14% in any year in the stock market is considered an excellent year, above average. If you're new to investing, you're relatively young, you're probably spoiled on the bull market that we've had in the last 10 years. Again, this is not the norm, nor was that other one back in the 90s. They exceeded, all the average length and gains of the, average bull market throughout history. So, like I always said, the bigger the bull, and I'm warned about this, the bigger the bear. And so this is clearly, by all accounts so far, early stage bear market action. And like I said, so no matter how convincing the next rally goes, it is most likely to be relatively short-lived, whether that's days, weeks, or months, probably somewhere in the weeks, several weeks span or so. Here, let me show you what I'm talking about. Here's something I've shared this in the past, and you guys have probably seen this or something similar. It shows the various stages of a bear market. Is what it's called. And so, of course, you have a bull market, and you look back. This is our early 2009 early stage. We did have in the middle of that market, and I'll show you that first big sell-off, and then you come on up, and you reach that new paradigm that's where everything is just hunky-dory. There's Goldilocks. You hear the word Goldilocks economy, super low unemployment, no inflation, blah 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 blah. We're going to go up forever, and that's how bull market ends. When there's a saying, it's always darkest just before dawn. That's the saying. What happens at the end of a bear market when it looks like things just couldn't get any worse? That's usually when it's about over, and just when things look like they couldn't get any better, that's when you're near the top. So here's where we're at now. Now I don't know if we're here or somewhere in between. But again, this is what we'll be looking for, and they call that the return to normal phase, where the rally is so powerful. That's the nature of a bear market rally, that it convinces the masses that the worst is over. And now let me say this. If they talk about a vaccine being at least a year away, but let's just say hypothetically something came out in a vaccine and everybody thought, okay, that's it. Coronavirus is over. No longer a risk. It's been contained, and now there's a vaccine, so they can hit it. The hot spots that pop up, blah 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 blah. You're going to see a rally, and you're going to be convinced the worst is over because coronavirus is over. But let me tell you this: I can't guarantee anything, but I can tell you, with a fair degree of conviction, the month isn't over. But I'm watching my long-term indicators, and they look like they're going to break. This is SPY. There's the bull market uptrend line, the lowest, what I call benefit of the doubt trend line. This yellow trend line was really our bull market trend line here. SPY broke it back in the late 2018 correction, and it's only back tested. So SPY broke down ahead of that. Was a long-term sell signal, and it back tested the trend line there, but now it's well below that 20-month EMA and my alternative trend line. So SPY is in a bear market. Again, we'll have to see how the month ends to confirm these monthly sell signals. There's QQQ cracking below the 20-month EMA, which again is one of my favorite long-term indicators. Very good, does a very good job of defining bull and bear markets, and a very clean bull market uptrend line, which is we're now trading below. Plenty of opportunity again, with today being the 19th, I think. Yeah, the 19th. We could certainly close on or near it, but I doubt we're going to close solidly back up in here. We'll see. I'll stay flexible. But okay, where am I going? This bear market has been priced in for a long time. It's been, and this coronavirus was just the catalyst. So where I'm going with this is there will most likely be additional legs down, even if coronavirus was wiped out tomorrow. I am a firm believer that the damage has now been done. The economy works in cycles. We are undoubtedly going to enter recession at this point in time. That's almost a near certainty, I think. And because of that, it'll then have a domino effect. There'll be layoffs, businesses will cut back. There's the government's throwing everything they have at it. But again, I think that the catalyst has triggered not just the bear market, but it's also triggered the next recession. And therefore, I'm just trying to share my longer term view right now, and not to get that confused with my shorter term view, because at any given point in time, I can be bullish near term, like I have been, coming into today in the last couple of days, looking at, buys off these levels, cautiously bullish, I'll call it. And, still open to anything that happens if the market takes another leg down. But I just kind of wanted to lay out my long-term view. Now let's look at a few other trade ideas. Here's, before we get there, QQQ is getting close, coming up on that downtrend line. That's where I expect, a reaction. However, I'm looking at QQQ. It could punch through the trend line and go up to T1 if SPY happens, because SPY hasn't hit my first target yet, which is the intersecting trend line and 250-ish level, and that would be another 3.25% upside from where we're at. And so if that happens, then you would expect that QQQ may go on there and probably take out the trend line at the same time and hit T1. So if you're looking to, a logical place, if we get there today, to book some profits, especially if you don't want to hold overnight. What happens in these futures overnight. But that can go the other way too. We've had futures hit lock limit up in the last week or so. It's not only a lock limit down situation or a big drop. All right, so that's my views on the market. I don't want to go over that. We already covered that. The other things that stand out, I posted below the last post on the homepage. Oil looking good. The same case that I made for a long yesterday, even though they took our stop out. And I'm glad we had it where it was because, from there, crude fell another. This is what stops are for, and this is why they're a must in a bear market. Had we not had a stop on that trade, it would have fallen. You would have lost another 14%. However, what the case that I made for a rally yesterday, remember I called this potential divergence on the 60-minute chart. Well, it's now been confirmed with that crossover. What the bullish crossover does, again, this is just me. It's not. I don't think you'll find it in the textbooks. It's what I call the difference of confirmed and potential. Confirmed divergence is once you get a bullish crossover that effectively puts in a higher low on the PPO versus a previous low, then you have confirmed divergence. Otherwise, those lines, even when the momentum indicators are heading lower, they can continue down and never get that crossover, and therefore the potential divergence never becomes quote-unquote confirmed. So it's confirmed. We're in the gap right now on USO, although it's coming up to the trend line there. Same target that I had. I shared that would be the same price target to backfill that gap, or the trend line too, because the trend line comes in first. And you want to also keep an eye on crude futures. I posted a chart today in the comment section. I encourage you, if you're new to the site, come in, because I'm not going to flood your inbox other than that snafu that happened earlier this week, and apologize. I know it was I think 700, 800 emails went out in a span of an hour or so between 2 and 3 a.m. That was due to the website migration. I already talked about that. That will not happen again, or I don't suspect it. It's never happened before. So I posted what I was getting at is in the comment section. I posted this. I'll do a lot of updates there, and even though I didn't post an update on crude earlier, I did follow up in the comment section might have been under one of last night's posts, and I showed you that somebody had mentioned yesterday that crude was still no buy signals on by their indicators, and I said this morning we did get one. We took out this downtrend line. This is a 60-minute chart of CL crude futures, and at the time, I'll show you that chart real quick. I can't find it on the, I might not have hit that reply button. I posted it under last night's update. Somebody, I think was member Tim Zacks, Timzacks, had mentioned oil chart, no buy signals. Now I'm not seeing my comment there. Sometimes I move so fast I don't hit the submit button. But this is a chart I took saying, look, I have, as of today, a buy signal break above the trend line and that 24.22 level. And I said this offers an objective long entry because we went up quite a bit and we pulled back, and that's nice support. You can see here. Let me zoom in a little for you. I know we're on YouTube. It's harder to see. That's a pretty objective entry. Because you had nice resistance there. You can see this almost like a ascending triangle pattern. Boom, boom, boom. Finally a breakout. We came back in, back tested it, and that's an objective long for the next target up there. That was earlier today at, where was it? 12 noon, right at 12 noon. So I want to just share this. Here we are. We've bounced off that level. A nice little lift so far. About let's try to measure it here, and that would be about a good for 6-7% so far actually on that. And again, that's the next target up there. So crude's looking good, and whether it gets there or not, I said if it takes that out, it could come in a back test. But this still should be the support that holds, and the continued advance in crude will most likely, not necessarily, but most likely be dependent on the stock market continuing to rally, and that's still a big if right now. And on USO, same target as yesterday. I mentioned, look, on one of the comment sections, there's I think in the past, I've used these as trading proxies for official trades on the site. The velocity shares 3-time long and short crude ETNs. That's DWT and UWT. Let's take a look at that. Remember, right now, let's see if it's changed. But earlier today, there was a huge disparity. This is an ETN, and I've talked about that. ETNs are different from ETFs. ETNs are exchange-traded notes. A note is basically an IOU from a bank or what other fund company is issuing that. And they have little nuances in there that if it blows up, because they, for whatever reason, they was mismanaged or it exceeded some thresholds that they didn't hedge against. Guess what? It's on you, not them. Those ETNs can implode and actually go away. We saw that a couple years ago in some of the VIX tracking ETNs when we had a huge move in the VIX back in 2018. So what I'm getting at, okay, so here's USO. USO is a one-time non-leveraged ETN, and it doesn't use leverage, so it's probably a little more secure than the others. It's also very liquid. It's been around for a while. It's up, you can see 11.89, so almost 12%. So therefore, and I haven't updated it since I posted on the front page, UWT, which is a 3-time long, should be up about close to 36%, right? 12 times 3, and it is only up 15%. It's trading at 30 cents now. So it is severely under lagging what it should do. It should be up 3 times what USO is. Chart is constructive, the same, but the fact that it is underperforming tells me something in there's broken, because usually this thing is not tick for tick, but darn close to 3 times what USO is. On the flip side, with a gain of 14, now 11.5% in USO, you would think that DWT would be down 3 times that. However, DWT is down 53%. All right, so I threw it out there in the comment section, but I just want to let you guys know that's not what I want to do. You might want to stay away from these guys right now. Doesn't mean maybe there's a reversion to the mean, maybe something, looks like it's at support and all that good stuff. But again, the fact that it's off so much for what it should be tracking right now tells me there's something broken there. So just kind of a heads up, you might want to stay away from those. Crude futures are a good, safer bet. USO is tracking well, and if CL is too big for you as far as the leverage factor in the futures contract, there's a QM, I think it is. There's a micro contract. Yeah, I'm pretty sure it's QM. The micro contract. It trades on the same levels as CL, so you can use my CL charts. It just has a much smaller leverage factor, so you're not exposed as much as you are to a single contract of CL. All right, so that's one trade idea I wanted to share today. And like I said, same with the equity markets. These are very constructive charts. Crude, I can sit here all day long and talk about how god-awful the fundamentals are for crude right now. With planes hardly flying, with cruise ships docked at port, with people being told to stay at home and not drive. I mean, think of the massive collapse in demand. Forget about the Saudis having that price war with Russia right now. That's one thing. Saudis said you didn't honor our cut agreement, Russia, so we're gonna pump all we want and we're gonna break you. That's what's going on there, because Saudis are the lowest cost producer, and so there's a little oil war going on there. That started the whole thing, but again, the collapse in demand is huge. So I've just sat in there and told you 100 reasons why you want to stay away from crude, or not necessarily why it should go down, but then you have to ask yourself the one simple question: how much of the 64% drop over the last 2.4 months it has priced in everything that I just said and brought crude down to where it was. So that's why yesterday I put the long trade on crude, and that's we were a day early, but our stop was negligible, and I just wanted to share it again. Is the reason it's rallying, and the constructive chart, the reason it could go up a lot more and hit this potential target. Again, because as I said, the pendulum always swings too far in the opposite direction. Everybody gets bearish. They buy those short ETFs, they short USO, they short CL, and those shorts are getting cooked today, with a 12% kickback rally. So again, like I've been saying, that the risk reward for shorting, whether it's the stock market or beat down commodities like crude oil, just is not favorable. That doesn't mean crude can't plunge another 20-30% or more. It just means that the upside gain potential, in my opinion, is larger than the downside profit if you were to short. Plus the risk of getting caught in one of these short squeezes, especially if you're trading something like USO that can gap up or down if the futures move big overnight, is there. So it's a trade idea. Like I said, take it or leave it if you're not comfortable with it. But it does look like it probably has a little more, especially if it can clear this trend line here, and especially if the stock market can continue to rally. Bitcoin, I did an update the other day, told you the charts weren't very clear, but I did lay out some levels and said, look, it bounced, it was hit that nice support there about 493. I'm talking about GBTC, the Bitcoin proxy, up sharply today. So they're buying this as, what I think is a proxy, against the, fiat currencies. Everyone's worried. The reason the dollar's surging, I should get to that and talk on that real quick. But by the way, there's resistance right here. I'm going to add a line. So I would not, Bitcoin could run up to here, big resistance overhead, but it's at the bottom of this gap right here, plus these reaction highs there. So it's at resistance. I think that move, a lot of that move may have already run its course right here. So I don't have a strong opinion. I don't think I'd care to short it, but I definitely wouldn't go step in long now. I just wanted to update it for those interested. And then the dollar has exploded. Yes, I had been bearish on the dollar, but not betting on the dollar. I just I use the dollar to confirm my trades on gold. We have an official long trade on gold, as you're probably aware of right now, and I'll show you that right here. And we already hit our second target. It's pulled back from there, and a lot of that is due, I believe, to the surge in the dollar and also forced selling in the markets. But the dollar is surging because, in the Wall Street Journal wrote about this, there's a massive demand for dollars, for U.S. dollars, globally right now. As I warned about recently, you're going to see the financial markets start to break if and as the stock market continue to fall, which it has, and the bond market. That's the other thing around. So you have things like pension funds, for example. They have to meet their obligations. They have to have enough cash on hand to pay out all the benefits over the foreseeable future, the next 6 to 9 months. And so, like it or not, they're going to have to liquidate positions, and there's just a scramble around the globe for U.S. dollars right now, and that's caused a sharp rally. Now, what does all that mean? Why am I talking about that, since we're not trading the dollar directly, or any trade, official or unofficial? Just using it to, for my analysis here. This is UUP. This is significant because that's a huge surge, again, caused by the pretty much the near collapse in the credit markets. The Fed has come in to backstop money market funds. They've come in to backstop the bond market. They're throwing everything they have at it. And again, there's this shortage of dollars. It's very real. When that abates, the dollar is going to come down. And what I talked about this before. Gold has been in a bull market along with the dollar, and I said, and I've showed you charts. If you're new to the site, I don't want to go too far off track now. Some of my previous videos showed it, but you can do it. Go back 20 years, overlay a chart of gold and the US dollar, and you'll see they have a very clear inverse correlation. When one tops, they look at the major tops and bottoms, and you'll see that usually when the dollar bottoms, gold tops, and vice versa. Now, what happened is there's been such strong demand for gold in the last year or so. I guess a lot of people saw the writing on the wall, knew the stock market was getting frothy. Hey, good time to start adding gold. I've been a big proponent of having gold as part of your long-term core holding in your portfolios for diversification purposes and, in capital appreciation. The charts were good. But the fact that gold rallied despite a rising dollar tells me the underlying demand was very, very strong, enough to overcome the effects of a rising dollar, because when the dollar goes up, it takes fewer dollars to buy a share of gold, and so therefore the price of gold usually will fall, and vice versa. But with gold rising and the dollar, so the point is, if and when the dollar reverses, when this little shortage of U.S. dollars abates, and you see a quick reversion back to the mean, or a correction in the dollar, that should be a net headwind for gold. As it, again, the dollar goes down in price, it takes more dollars to buy an ounce of gold. Therefore, the price of gold, all other things being equal, goes up. By all other things being equal, I'm talking about supply and demand forces. In a vacuum, a rising and falling dollar would make gold go up, down, tick for tick. where in the real world you have supply and demand forces, more people sometimes wanting to buy gold or sell gold for whatever reason, and that's that. So I just wanted to kind of update that and say, look, the technical posture of the dollar, it has changed because we broke out of this multi-year high right here on UUP. This is the dollar ETF, but the divergences that were in place here are still in place. They've only extended. So this has the potential to prove to be, and I think it will prove to be, a false breakout, and fewer things are more bearish than a failed breakout. So if UUP and dollar falls back below that level, that should be pretty darn bearish for the dollar. And again, I've always said, breakouts that occur while extremely overbought, just overbought period, with negative divergences have a increased rate of failing. So I wanted to talk on that. And then gold again. So as of now, we'll sit tight on the gold long trade. It's comfortably above our stop for the time being. Here's XLE, the energy sector ETF. It's just been clobbered. That's a monthly chart. There's a weekly chart showing it trading right around that 29-ish support. Not a solid support level. This is in free fall. But you do have, similar to crude oil, you have a potential divergence. So if and when the market can catch a bid, and if oil continues to rally, I think XLE is poised to outperform certain sectors, or the majority of sectors within the S&P 500. So there's one that you can look at. Again, if we see some stabilization here and the market goes up anytime soon, and if not, we take another big leg down, we'll just revisit this one later. But again, getting very oversold, and starting to look pretty attractive there from a risk-reward perspective. And I just gave you a downtrend line you can see. So break of that downtrend line, take you up to about the 27 level. That would be your first target, and that's resistance. And if we break 27, then looks like a run up to about 32-ish is pretty likely there. So there's another potential trade idea. And then finally, I did a video, was it last week or early this week, showing the sectors in the S&P 500 and why I thought that the downside was probably limited. As of earlier this week on that big down, really since Monday or last Friday. XLK, the largest component of the S&P 500, at support so far, holding that support. Kissed it. You can see a candlestick yesterday. Kissed it, that 70.19 level. I've had that level there in advance. We had a low of 70.27, close enough. Holding above it doesn't guarantee it can't break. If it does break, not a good thing. It's pretty much the same story. If we can hold above yesterday's lows for the time being, at least the markets, maybe it's just a consolidation area, maybe it's getting ready for a little bit more of a bounce. Healthcare, just to run through these. Big level there, support zone that I had, and we hit the bottom of the support zone yesterday, or close enough to it. That's XLV, second largest sector. Financials, like I said, one thing I was looking for a bounce in the market, because financials just can't go much lower. If they go, they've already, I'm worried about a blow up, and now I'm starting to finally see that in the Wall Street Journal, some other headlines where the financial system is at risk right now, and the Fed is coming in, and Treasury to do everything they can to backstop it. So like I said, these banks, they go much lower, and this is it's pricing. It's a little concerning too. What is the pricing in? The banks have fallen a lot more than the S&P 500. Is there trouble? I have no doubt that they're at risk right now. Is there a blow up right now that's being covered up, or at least trying to be mitigated or controlled by the Treasury, by the Fed? I don't know. It's possible. So these are the real risks right now in the stock market economy. But again, I think at this point, Fed's thrown everything they can, or a lot of stuff at it. So we'll probably get a bounce here, a relief rally, and that sector could outperform because it's so oversold. So that's one to watch too. Just got to be careful. Any of these positions you take going home, don't be fooled by the first very strong rally, whether it comes soon or whether it comes at lower levels. Never trust a bear market rally. I love them. They're fun to trade, embrace them, but just don't fall in love with it. And again, I've said this over and over. If you either stay out of this market, watch, learn, observe right now, Or if you want to trade it and go off some of these trade ideas, just keep your position sizes very small to account for the above average gain and loss potential. So if you normally trade whatever your number is, $10,000 of SPY or QQQ, go with a few $1,000 or whatever that number is for you that's much smaller, because if you get some of these swing trades right and these bounce trades, you're making double-digit gains in just a couple days here, like crude oil and even the markets. Likewise, if you get caught in a gap down against your position, and you don't have your usual full-size position, well, you might lose, 15, 10% or more on a stop, if you're stopped out. But it's not going to kill you if you took a reduced size position. So it cuts both ways. The profit potential is larger, so it makes it worth your while to take that smaller position. You're going to make about the same amount of gains you might normally in a low volatility market. And likewise, your most important thing right now, I think more so than trying to make profits, is loss mitigation. And if you are a swing trader or an investor and you're waiting for the next time to start picking up bargains, like I said, I can tell you that any time in the foreseeable future, any bounce that I'm looking at best we'll probably be looking at a maybe multi-week to maybe month, 2-month long bear market rally, with most likely more downside to come, because again, by all accounts, this looks like the beginning of a bear market and not the end of one right here. This is just a single wave down. Bear markets don't end. I've never seen one that's ended with a single wave down. You usually have kickback rallies along the way. All right, I think that's it. Yeah, I'll just rifle through some of these other sectors. XLC, the new communication sectors, replace the telecom sector in the S&P 500. We don't have a lot of charting history to go by, so we don't have a lot of good support and resistance levels to work off of. We had a trend line that broke there, started that, but traders will flock to a reaction low like that and step in and buy, and that's what they've done so far. That was the drop back in the December of 2018. So there's XLC so far falling to and hitting and holding support. I'm on a weekly chart. You can look at it daily, and again, same story like the stock market here now. Step back, it's really been the last few days the market's kind of hit that floor, whether it's the government supporting it or whether it's just natural supply demand forces, buyers stepping in, or probably a combination of both. I mean, the government's supporting it, we certainly know indirectly, by pumping liquidity into the system, but whether they're actually have an active hand in buying stocks and futures, I don't know. There's always talks about the PPT and all that stuff, plunge protection team. XLY, there it is. That was a consolidation period. You can see some support levels on here. Actually, there's that big level back there from late 2015, 2016, and that's I've talked on this level quite a bit. That's where my longer term bear market target is on SPY, and even QQQ might get down to that level at some point, but SPY will get there first if it does. But XLY hit that, so I'm going to wrap it up here because this is the same thing I did a few days, showing you that at the time there was a little more downside. We were very close to, but not all the way down to a lot of those support levels on the various index sectors that within the S&P 500, and you can see, turn that line on. That's that high from 2015, the top of that trading range, and you can see we went on to hit it since then. I did the video here the other day. I showed you a lot of those sectors were very close, but not there. So that was that final thrust down that tagged those support levels on just about all these sectors in the S&P 500, and so far we've held. And that's bullish unless taken out. Oversold at support, which with successful defenses. And like I said, we could be looking at a little more upside here in the near term, and I'm leaning that way now. All right, I'm going to wrap it up here. It's a long video. Get it out to you guys. And if I see anything else that stands out, I'll put up some static charts maybe under this post in the comment section. This is Randy Finney with Right Side of the Chart. Hope you enjoyed it.